In this video, I want to talk about an idea that I picked up from this book, and it's Larry Williams' Long-Term Secrets to Short-Term Trading. I hope you can see that. I've taken the cover off it because I find them really annoying. And in it, at exactly page 155, he talks about an idea that he calls greatest swing value, or GSV. And I'm going to show you, or explain to you, what GSV is, very briefly, and then I'm going to show you a practical way to use GSV to create a profitable trading strategy. Now, Larry trades futures and stocks. He doesn't trade Forex. I mainly trade Forex, so I'm going to try and apply his idea of the greatest swing value to the Forex markets. And going by much of the other stuff that I've learned in this book and the other stuff of Larry's, I suspect that it will work quite well. We're going to be looking at the daily charts of euro-pound for this particular study. Now, greatest swing value, or GSV, is a number calculated looking at the buying or the selling pressure of a particular market. Now, Larry calculates this in different ways. He's described minor changes in the book. Sometimes if we're looking at long trades or buying, then we're only looking at bars that have an up close. However, in this example of this trading strategy, if we've got a long setup, I'm still going to use every bar, whether it was an up close or a down close. But I know it sounds a little bit complicated now. It'll become much clearer when I explain it visually on the whiteboard. So if we're looking for a buy trade now, that means we will have a buy or a long setup in place, which I'm going to explain to you about. Then to calculate the GSV, what we're looking at is the previous 4 bars. Now, Larry actually says look at the past few bars. He does use an example of 4 bars, and in this case, for this strategy, to keep it constant, I'm going to use the previous 4 daily bars. We calculate the GSV by looking at each of the previous 4 daily bars, and we look at the distance between the high and the open of each bar. So that means we're looking at the buying pressure, how much that the market has rallied or managed to move upwards. Once we've got the distance for each of those bars, we add them all together, and that gives us the collective for the past 4 bars, and then divide it by 4, and that will give us an average value. So that will give us an average GSV, or the buying pressure. Once we've got that value, I'll explain how we use that value to trade on the next bar. And the opposite goes for shorts. Once we've got our short setup, which is obviously going to be a different setup to the buy setup, got our short setup, then we look at the past 4 daily bars, but we look at the relationship between the opening price and the lowest price. So to get this on each of the bars, we then look at the open, and then we subtract the lowest price, add all the 4 together, divide by 4, which is going to give us an average short GSV value. Once we have the value for the long or the short setup, what we do the next day, let's say we're going to go long, so we've got our long setup, we've calculated our long GSV, then the next day we look at the opening price, and then we add on that GSV value to the open, and then that gives us an average GSV. So we want to say if the market rallies past or up through this average over the last 4 days, then likely that the rally is going to continue. So then we use a stop order. So we got our opening price, got our GSV, let's say the GSV is 20 pips, then we add on 20 pips to the opening price, create a stop order. Then during that day, if the market does rally through that, then we'll get in the trade, and hopefully it will continue to rally further and it will be a profitable trade for us. If it was a short trade, we look at the opening price, and then we would subtract from it our GSV for our short trades. But we don't just do this every day. I've already mentioned we have a long and a short setup, and I'm going to explain the setup. That's quite simple. I'll explain that when we go to the whiteboard now. In this example on the whiteboard, we're going to assume we're going to be taking a long trade. First thing we need to do is look for the long setup. In fact, that's the first thing. Do we look for a long setup or do we look for a short setup? If we've got a long setup, then we're not going to bother calculating the short GSV. Okay, so first of all, let's look for the setup. Now, the setup to go long, we want to be looking at a short-term weakness. So to do that, quite a simple one, we're just going to be looking at the past 4 daily bars, and is the low of this bar, the most recent bar, the lowest over the last 4 bars? If it is, then that's our long setup. If we want to go short, then we're looking for the highest high over the last 4 daily bars. And that's an indication that there's some short-term strength and we want to go short because we think that the market may revert back to the mean and give us some profit. So in this example, we've seen that we've got the lowest low over the last 4 bars, and that's our setup to go long. So the next thing we need to do is calculate the GSV value. Now, the long GSV value, as I mentioned, is calculated by looking at the relationship between the high and the open of the bar. Put these blue arrows in so we can see if we subtracted the opening price from the high price, that would give us a value. Let's say that's 5 pips. The next bar, look at the relationship, subtract the open from the high, let's say that's 15 pips. Here again, let's say that's another 5 pips. So we've got 25 pips so far, and let's say this one was 10 pips, we've got 35 pips. Once we have the total of each of the 4 bars, we divide it by 4, and that will give us our average long GSV value. Now, once we've got that value, then at the open of this next bar, then what we do is we add on that GSV value for a long trade and we create a stop order. So the market is going to open here and the stop order might be here somewhere. If the market rallies, then we want to be getting in and we want to buy. Now, there is one more twist with the GSV, if you like. Larry suggests not using the actual GSV value. Let's assume at the moment our GSV value is 9 pips. Let's say 10 pips for ease of calculation. So we don't just add on 10 pips to the opening price. He's found that a figure of 180% of the GSV value works quite well. So in this case, if our GSV is 10, he says that 180% works well. So it wouldn't be just 10, it would be equivalent to 18 because that's 180% of 10. So we would actually add on 18 pips, not just the 10 pips. Now, I don't know if 180% is a good value. He's tested futures, stocks. I'm looking at a completely different market. I'm going to be looking at euro-pound Forex pair. So I'm going to test. I'm going to see if 180% is the best. I'll probably test from something like 50% right up to, I don't know, 300% perhaps, and see if 180 is a good value, or perhaps there is a better value for this market. In terms of exits for the trade, of course we're going to have our stop and reverse type exit, which means that if we've got in and we've bought, the market has rallied, then the exit is going to be a reversal. So we're going to wait for a short sell setup and an entry to the short trade. That's going to be our stop and reverse exit, which always work quite well. But I'm also going to test out the first profitable close. So looking at towards the end of the day, if we're in profit, close out the trade. Now I am going to add perhaps a daily delay on that, because if we exit on the day that we get into the trade, it doesn't give us a lot of time to make profit. So I am going to add in a delay, which I'll explain when we move over to the computer and look at the results now. I'm going to carry out all the testing on data from 2008 through to the end of 2018, and then make some adjustments and changes, and then test it out on data from 2019 through to the end of June 2021. That will give us 2.5 years of out of sample data that the study hasn't looked at or I've optimised the strategy on, and that will give us some sort of an idea of whether or not the strategy is likely or not to make money going into the future, which is obviously the goal of creating profitable trading strategies. So let's look at the first study. So in this first study, you'll notice actually it's euro-pound on the 15-minute chart. However, that's purely for programming purposes. we're looking at the daily bars like I demonstrated to you on the whiteboard, and then adding on that long GSV or the short Gsv value to the opening of that most recent daily bar. Now, currently, the values for this study, we're looking at 100% of the Gsv value. So that means we're adding up the Gsv for the 4 previous daily bars, dividing it by 4, and then taking that value as it is and adding or subtracting onto the opening price for long or short trades. We're not using the 180% that Larry recommends. And there's no other exit apart from a stop and reverse exit. So you'll see, look, here we've got into a short trade and it was a losing trade, and that exit was a buy trade. That buy trade was actually a winning trade, and we exited and then entered a short trade. So it's currently stop and reverse. There's no stop loss and there's no exit if in profit by the end of the day. First profitable close exit. That's going to come later. There's the equity curve spanning from 2008 through to the end of 2018, and it's okay. It's not great. We've got a massive drawdown in the recent years, so that's not particularly good. We're making almost £27,000. Got an average trade of £60, and we've got 442 trades. So the next thing to do is look at that 180%. So Larry suggests 180% of the GSV. We've seen the results using 100%. So I decided to run an optimization for the GSV value in terms of percent. And I ran that, I called it GSV percentage, and I've run it from 50% all the way to 400% here at the bottom of the page. So looking down the results, I'd like to look at the average trade value and the net profit. Let's look at 180%. You remember just now we looked at results using 100%, which are here, almost 27,000, average trade of £60. Using 180%, we're actually making less net profit, slightly more on the average trade, which is good. But if we continue to look down these results, we can see that 180% for this strategy is certainly not the best. Looking down them, I actually like the results around here, which is 250%. We've got a net profit of 28, so similar net profit, but we're making fewer trades, but they're of higher quality. Look, we've got an average trade of 160, which is actually the highest amongst this kind of stable area. We have got higher ones here, but I don't think they're as quite as stable because look, 280%, if we go to 300%, the results really do drop off. The net profit drops off, the average trade drops off. I think 250% is a nice central stable area. So we're going to use 250%, not 180%. So let's look at the equity curve. And the equity curve is better. It is slightly, we've still got some big drawdowns, but it is slightly better, certainly in later years. We already know that we've got a net profit of 28,000, almost 29, and an average trade of £160, which is much better. So next we want to look at an exit rather than just a stop and reverse, rather than just an entry in the opposite direction. And I mentioned that we're going to use the first profitable close exit. So I've actually used a time of 16:45, which is 15 minutes before the close of the session. So 16:45 Eastern Standard Time. We're going to look once we're in the trade, and at that time we're going to check to see if we're in profit. If we're in profit, then we just exit the position. If we're not in profit, we leave the position open. However, I don't want to do that the day that we get into the trade because we're going to be in the trade for not enough time to make a big enough profit. So the way that I've programmed the strategy, I've done it so that I can use a day delay, I call it. And I've done it so I can optimize or look at what is the best day delay. So I can say only get out in profit at 16:45 if we've been in the trade more than 1 day, 2 days, and I've tested that so we can see how many days is it best to stay in the trade before we use the first profitable close exit. So let's have a look at the optimization, see what works. So here's the optimization report, and I've used from day delay of 0 through to 20. -1 isn't using this exit whatsoever. -1 uses the stop and reverse exit that we've already seen. So looking down these results, I find that I like the results from using a day delay of 8. So we're saying, let's stay in the trade for 8 days and then start looking at 16.45 every day. Are we in profit? If we're in profit, then we get out. If we're not, we stay in the trade and have a look the next day at 16.45. And it's done a lot for the net profit and the average trade. We were on 28,000, average trade of 160, using 8 days delay. We're up to almost 46,000 and £217 on the average trade. So that's quite pleasing. And we're actually making more trades as well because we're getting out of trades earlier than using just the stop and reverse exit. So let's use that and see how it looks on the performance report. We've already seen these numbers, 211 trades, 72% profitable, £217 average trade. Let's have a look at the equity curve. And the equity curve is the best yet, I think. Still got some nasty little drawdown periods, but overall that is a smoother equity curve, so I'm happy to stay with that. So the next thing I want to do is look at a stop loss. I'm going to use a fixed pip stop loss because they tend to work well, and I've got no idea what works best, so of course I've run an optimization, and I've run an optimization from 0 through to 300 pips. The stop loss does tend to reduce performance a little bit. You remember we got a net profit now of nearly 46,000, £217 average trade. And looking down these stop loss values, I find that the best area is around here, is about 190 pips. In fact, I might even go, just call it around 200 pips. We've got a slight reduction in the net profit and a reduction in the average trade. But we do need a stop loss, and the stop loss does give us less max intraday drawdown. We've only got 10,800 as opposed to having 13,400. So let's use 200 pips for the stop loss. And looking at the equity curve, it's very similar. And we already know our numbers in terms of net profit and average trade because we've just seen those. And that's about as far as I want to go with the development of this strategy. The next thing we do need to do, or I do want to do, is look at the out of sample data. We've got 2.5 years of the most recent data to check the strategy to see how it's working. And that might give us an indication of whether or not the strategy is going to continue to work in true future data and make us money in the future. But before I do that, if you're enjoying this video, why don't you subscribe to the channel and please give me a thumbs up because that really helps too. So in this final workspace, we've got the same inputs like we've looked at. We've got the 8-day delay, we're using 250% of the Gsv value, and we've got a 200 pip stop loss. But we've got the additional data. So looking at the equity curve, we can see we are making new highs, which is good. If I look at this chart, the green dots show us the new highs. If you remember, before that we had data up until around about this point here, which was the end of 2018. So where my arrow is here, this is where we had data for, and then now we've got the extra 2.5 years. We could see that we have continued to make profits into the out of sample or unseen data, which is good news. Let's just look at the numbers. We've got more net profit, obviously. We've got more trades, they're more profitable trades. The average trade will be interesting. We've got an average trade of £176 now, which is only a couple of pounds less than the rest of the study. So that means that the out of sample data has been fairly consistent with the rest of the study, which is exactly what we like to see. I probably won't jump in and start trading this strategy straight away. I shall leave it in a watch list and look at it in maybe a couple of months' time to see how the performance is. See if it's still in line with the backtest and continuing to make money into true future markets. And then I'll consider fitting it into my own portfolio of trading strategies. In conclusion then, I've demonstrated you an idea from Larry Williams which he came up with decades ago and used successfully on the futures and the stock markets. And I've taken it and applied it and showed you how you can use it on the Forex markets. Euro pound was actually the first market that I've tested this on so far, and I picked it because a keen viewer of mine on this channel, Herman, he actually was emailing me, talking to me and saying that Euro pound was quite a difficult market to create consistently profitable strategies on, and he's right. I've also found that in the past too. So I thought, what better market to have a go with this new idea, Euro pound. So that's why I've chose Euro pound. However, I am keen to test this idea of the GSV on some different Forex markets to see if I can make some profitable strategies with those too. So I hope you've enjoyed the video, and I hope you might have sparked some ideas for yourself. Test some ideas out for yourself perhaps. And don't forget, leave a comment or a question down below. But until the next one, this is Jared Goodwin, and thank you.